If you are a U.S. freelancer, an independent contractor, or a small business owner filing a Schedule C this year, stop what you are doing and listen closely. The rules of the game have completely changed for 2026. The IRS has deployed over 125 artificial intelligence and machine learning models to scan your tax return, up from just 54 models 2 years ago. They are not just looking for simple math errors anymore. They are cross-referencing your 1099s, your crypto transactions, and your side hustle income faster than any human auditor ever could. And Congress just passed the One Big Beautiful Bill Act, which radically changed the 1099 reporting threshold starting in 2026. What you thought you knew about avoiding an audit last year could literally be the exact thing that gets you flagged this year. Today, I am walking you through the complete list of 2026 IRS audit red flags for Schedule C filers. Exactly what the algorithm is hunting for, the traps you are probably falling into, and how to bulletproof your return so you can keep more of your hard-earned money. Let's dive in. Red flag number 1. The phantom income trap. Red flag number 1 is the biggest trap of 2026, unreported income due to the new 1099 thresholds. For years, if a client paid you $600 or more, they had to send you a 1099 NEC. Starting in 2026, that threshold jumped to $2,000. That means you could have 5 different clients each paying you $1,500, and you will not receive a single piece of tax paperwork for that $7,500. And here is where people make a massive, expensive mistake. They assume that because they did not get a 1099, the IRS does not know about the money. Wrong. You are legally required to report every dollar of business income, regardless of whether you receive a form. The IRS Automated Underreporter Program already has copies of every 1099 your clients filed before you even submit your return. If your Schedule C shows $40,000 in income, but the 1099s the IRS already has from your clients add up to $65,000, the system flags that discrepancy instantly. And if you get paid through PayPal, Venmo, or Cash App, under the One Big Beautiful Bill Act, the 1099K threshold has been restored to $20,000 and 200 transactions. But your tax obligation has not changed. Report everything. Red flag number 2, the perfect business vehicle. Red flag number 2 triggers an audit so fast, it will make your head spin. Claiming 100% business use of a vehicle. For 2026, the IRS standard mileage rate is 72.5 cents per mile, the highest it has ever been, up 2.5 cents from last year. That is a massive deduction. But if you tell the IRS you drove 15,000 miles this year, and every single one was for business, you are practically begging for an audit. The IRS knows that human beings go to the grocery store, pick up their kids, and go to the gym. If you only own one vehicle and claim 100% business use, the algorithm flags your return immediately. If you drive a dedicated work truck, 100% for business, you need a personal vehicle registered in your name to back that up. Otherwise, prorate your usage. Use an app like MileIQ or Everlance. If you get audited, the examiner will ask for your contemporaneous mileage log. That means a log kept at the time of each trip, not something written the night before the audit. Red flag number 3, disproportionate and rounded deductions. Let's talk about the DIF score, the discriminant information function. This is the IRS master algorithm that compares your Schedule C to thousands of other businesses in your exact industry and zip code. If the average freelance graphic designer in your state claims $2,000 in office supplies, and you claim $14,000, your DIF score spikes, and a human auditor gets assigned to your return. You are allowed to take large, legitimate deductions. But if they are disproportionate to your income, like earning $50,000 and claiming $40,000 in expenses, you need bulletproof documentation for every single line. And here is a rookie mistake you must avoid. Round numbers. If your return shows exactly $5,000 for advertising, $2,000 for meals, and $1,000 for travel, the IRS knows you are guessing. Real business expenses are messy. Your travel cost $1,043.22. Your advertising was $4,831.90. When the AI sees neat rounded zeros on your Schedule C, it assumes you did not keep records. Be precise. Red flag number 4. The endless hobby loss. Red flag number 4 is the hobby loss, and this happens all the time to W-2 employees who start a side hustle to lower their overall tax bill. Say you make good money at your day job, but start a photography business on the side. You buy $15,000 worth of cameras, take a few trips labeled as location scouting, and report a massive loss on Schedule C to wipe out your W-2 taxes. You can do this for a little while, but the IRS has a strict rule. Your business must show a profit in at least 3 out of 5 consecutive years. Report losses year after year and the IRS will reclassify your business as a hobby. If they rule it a hobby, every deduction disappears. Worse, they can go back and audit prior returns, disallow the losses you already claimed, and hit you with a tax bill plus penalties and interest. If you are genuinely running a business at a loss, document your profit intent. Keep formal books, maintain a separate business bank account, and have a written business plan on file. Red flag number 5. The crypto blind spot. Finally, red flag number 5. If you accept crypto as payment or trade digital assets, the Wild West days are officially over, and this filing season is where it becomes real. Form 1099-DA is now live. Starting with the 2025 tax year, the return you are filing right now, digital asset brokers and exchanges are reporting your transactions directly to the IRS. That same AI matching system we talked about is now fully integrated with crypto data. If a client paid you in Bitcoin, or you sold crypto and did not report the gains, the IRS computer will automatically generate a CP2000 notice and send you a bill. The blockchain is a public ledger, and the IRS now has the tools to read every transaction on it. An IRS audit does not have to be a nightmare if you operate like a professional. Do not let these red flags scare you out of taking deductions you are legally entitled to. If you bought equipment, deduct it. If you drove for a client, claim those 72.5 cents per mile. But document everything. Keep business and personal accounts completely separate, save receipts digitally, and log your miles in real time. If your business is growing, or you are pulling in serious income, do not do your taxes on a laptop at 11 p.m. on April 14th. Hire a CPA or an enrolled agent. That investment is the best audit protection you can buy. If this video helped you avoid a costly mistake on your Schedule C, hit that subscribe button and drop a comment below with your biggest tax question. I read as many as I can. Stay profitable, keep your receipts organized, and I will see you in the next one.